Underwriting is the basis for offering investors projected returns that we have. We can't just go out and say, hey, we're going to buy this $50 million deal, and I think this deal is going to get you a 2x, don't ask me how. This is the data side of the entire investment and the quantitative side. So we quantitatively arrive at a specific return threshold for our investors, and it's supported by the underwriting. It doesn't take into account a lot of the qualitative aspects, which are equally as important. So once we are able to qualitatively vet a deal, that's when it goes to the quantitative aspects, and that's where we support what returns we can project for investments. When a broker reaches out, or when Zach or Brady source a deal, as soon as we have financial information for that deal, we'll start underwriting. It typically takes about a couple hours to vet a deal and send it through the entire underwriting process. Obviously, it's all numbers, so we can come up with a pretty good guess of where we think we can size out a potential acquisition, but that's on the quantitative side. On the qualitative side, which I would say is also part of the underwriting, we have a team that walks the property, sees the location it's in, and provides a go, no-go. So if they think the location's bad or there's too much deferred maintenance at the site, we basically drop the deal. We want to make sure that we're being as conservative as possible on the deals that we acquire. So we obviously look at from an estimates perspective, because that guides a lot of the process. We want to make sure that it's tied down to market reports or some sort of economic research that we've done or that we can source on. The underlying data perspective, we want to make sure we start with good data. We don't ever assume what the expenses are going to look like or what the rents are going to look like without actually getting the data in. So being reasonably conservative and pursuing these deals is very important. The way we look at these deals, we break it down into 3 steps. On the first step, we just look at the micro data in that specific market. What does the annual household median income look like? What's the crime scores? Is there a school nearby? Is there a park nearby? Is it in an industrial zone? From that first level, if there's no glaring red marks, we move to level 2. Under step 2, we'll underwrite the deal completely front to back, and we're trying to be as aggressive as possible because we don't want to kill a deal when it meets the location metrics. I know we said we want to be reasonably conservative, but under step 2, we're trying to be as aggressive as possible. That's supported by market. So if, say the average rent per square foot in that area is $1.90, we're gonna peg everything to $1.90 and see, okay, well, does it make sense? We're trying to make sure the deal can go to level 3. Under level 3, we'll take in all the qualitative aspects of the walk that our asset management team does, and then we'll pare back the underwriting. So instead of $1.90, maybe the best rent we can get is $1.85 per square foot, so we'll pare that back. Or if we're assuming $1,650 for payroll, but this specific deal is going to need $1,800, we'll increase that. So under level 3, it's kind of like, okay, we pushed it to the max, now we're going to pare it back to see where it actually is going to end up. We want to make sure that we tie back to third-party research that's been concluded on market growth rates or expense growth rates. Any item that we can tie to third parties, we tie to third parties. Anything we can pin to, let's say, CoStar or RealPage or state law, we try to pin it to that. Anything that we do control, we try to look at our historical performance and try to pin it to that. It typically takes about a couple hours to underwrite a deal at the very least. And right now we're trying to reduce that down. We're trying to implement a new software to help reduce that 2 hours down to 10 minutes. That gives us more time to review and ask more critical questions about the deal, as opposed to making sure that contract services are appropriately categorized in the underwriting. We stress test every single deal under looking at what the exit caps look like and what the rental growth rates look like, and we present all that to investors as well. So when we stress test a deal, we try to say, okay, well, what if rent growth is non-existent for the entire 5 years? What if exit caps expand more than we expect them to, and present that information to investors. We've reviewed, I would say, over 1,000 deals since we started. I would say our acquisition rate is around 2.5% right now. The reason that a lot of deals don't work out is just unrealistic expectations on purchase price. If the seller is way different from where we are, then those deals just don't end up penciling. So 97.5% of the deals, there's just too big of a gap between what we can buy it at versus what the seller can sell at. For people that are new and investing in multifamily, the number one thing to make sure you're aware of is you're starting with good data. I think the old saying, is garbage in, garbage out, right? So if you're working with financials or projected rents that are completely inaccurate, you're gonna have a bad time. Making sure that you're starting off on the right foot with the right data set and you guys have walked the property, you've seen it with your own eyes, that's a great place to start. Trying to just underwrite deals off of your computer and just Google satellite images and trying to put in an offer purely based on that, it's not going to work out very well. I would say our underwriting philosophies stayed pretty consistent. We don't venture into new builds or retail or industrial, etc. We stayed to value add multifamily because that's the one product where we can control NOI growth and it's not completely dependent on the market. But we've tried to be as defensive as possible on the underwritings. So we try to make sure that, as we're underwriting rent growth, or concessions, for example, it's actually in line with where the market is at or where the market is expected to be. So we try to, stay pretty consistent, but evolve as the market evolves.